Crypto is seen by many as the Wild West of finance, meaning that there's little regulatory scrutiny and almost anything goes. Well, what if I told you that this Wild West was about to see a new sheriff ride into town who could either straighten things out or make them even wilder? Recent changes at the SEC foreshadow significant changes to US crypto regulations, which could not only result in enormous inflows into crypto, but could also bring about a 1929-style market crash. That's why today we're going to explain what the SEC is, bring you up to speed on what it's been up to, introduce its new head honcho, and tell you how all this could affect the crypto market. My name is Guy, and this is a video you can't afford to miss. Let's start with a bit of background. The Securities and Exchange Commission, or SEC, regulates financial markets in the United States, specifically securities like stocks, bonds, and some cryptocurrencies. The SEC was established in 1934 as a response to the market crash of 1929, which led to the Great Depression. Remember that fact for later. Now, as most of you will know, the SEC has historically been extremely hostile to the crypto industry. This is mostly because many cryptos are technically securities. For context, a security is an investment of money in a common enterprise with an expectation of profit that derives from the efforts of others. Put simply, if you use money to buy it, if the price action is the same for everyone who bought, and the expectation of profit is coming from the actions of a third party, then it's a security, and therefore needs to be registered with the SEC. For most cryptos, it's the fourth criterion that ultimately determines whether they're a security or not. As many of you will know, most cryptos are built by for-profit companies, but are managed by non-profit entities, usually overseas. This setup basically allowed crypto projects to evade SEC scrutiny for years, since they could argue there was no specific third party driving the expectation of profit from their coins or tokens. This all changed, though, in April 2021, when Gary Gensler became the chairman of the SEC. Unlike previous SEC chairs, Gensler was hyper-aware of the methods crypto projects use to evade SEC scrutiny, as he taught courses about crypto at MIT. And not only that, but he also had close connections to big banks, having worked at Goldman Sachs for most of his career prior to working as a regulator at various agencies. Now, in case you didn't know, there's essentially been a battle for control behind the scenes at the SEC for years. On one side, you've had big banks like JP Morgan wanting the SEC to crack down on fintech, crypto, and other emerging technologies that threaten their dominance. On the other, you've had asset managers like BlackRock wanting the SEC to permit everything so that they can make even bigger profits. From our perspective, it's clear that Gensler was aligned with the big banks in this battle, and it's possible that this was a part of why the SEC's crackdown on crypto was so harsh under his reign. But, as all of you will know, Gensler stepped down as chair of the SEC on the 20th of January this year, just before Donald Trump took office. And as soon as he'd vacated the building, the remaining SEC commissioners wasted no time in moving to undo most of the damage that he had done. In case you missed it, a load of crypto lawsuits have recently been thrown out or paused, and many anti-crypto rules announced by the SEC in the past have been rolled back. At the same time, acting SEC Chair Mark Ueda established a crypto task force that's been hosting a series of roundtables about how the SEC should regulate crypto. The initiative is being led by pro-crypto SEC Commissioner Hester Peirce, also known as Crypto Mom, and the results could be insanely bullish. Meanwhile, by early April, politicians in the Senate had approved Paul Atkins to be the next chairman of the SEC, and by the end of April, he'd taken up his post. Last month, Atkins testified before Congress, declaring that it's a new dawn at the SEC and effectively suggesting that the regulator is about to go to the other extreme. In other words, it looks like the SEC is on the brink of lifting most of the restrictions on crypto, allowing for everything from airdrops to DeFi to staking, things that were all off limits to US investors under previous SEC chairs. This could result in a crypto boom bigger than anyone could ever have imagined. But the resulting bust could take us back to a very dark time in financial history. More on that later. By the way though, if you're finding the information in this video helpful, then help others find it by smashing that like button, and be sure to subscribe to the channel and ping that notification bell to help yourself find the next one. Now, if you'd never heard of Paul Atkins until recently, you're in for a treat. He probably has the most interesting profile of almost any person we've reviewed in crypto. In fact, it wouldn't be an exaggeration to say that it's nothing short of insane. For starters, Atkins was previously an SEC commissioner from 2002 to 2008. Newsflash, but this means that he was working at the SEC before and during the 2008 financial crisis. Now consider this. Quote, in 2004, the US Securities and Exchange Commission relaxed the net capital rule, which enabled investment banks to substantially increase the level of debt they were taking on, fueling the growth in mortgage-backed securities supporting subprime mortgages. The SEC conceded that self-regulation of investment banks contributed to the crisis. That's from Wikipedia, by the way. Now, can you guess who voted in favor of relaxing these rules? That's right, Paul Atkins. Not surprisingly, he was asked about these and other decisions he made at the SEC during the 2008 crisis at his recent hearings. What's surprising is that he effectively said that he has no regrets because there were other factors that contributed to the crisis. Now, if you thought that was crazy, here's another thing to consider. Quote, according to former SEC employee and whistleblower Darcy Flynn, also reported by Matt Taibbi, the agency routinely destroyed thousands of documents related to preliminary investigations of alleged crimes committed by Deutsche Bank, Goldman Sachs, Lehman Brothers, SAC Capital, and other financial companies involved in the Great Recession that the SEC was supposed to have been regulating. But wait, there's more. After leaving the SEC, Atkins founded an advisory firm called Patamac Global Partners in 2009. Patamac's purpose was presumably to help entities on Wall Street navigate SEC regulations. As you might have guessed, though, it appears that Atkins' services were not limited to TradFi. He also catered to crypto. For example, he got involved with a crypto lobbying group called the Digital Chamber of Commerce in 2017. And if you've been keeping up with the crypto headlines, chances are that you've seen a few about a crypto called Reserve Rights, which rallied as Atkins was making his way through the SEC chair approval process. If you've read those articles, you'll know that's because Atkins advised the project back in 2019. Reserve Rights has a rabbit hole of its own, which we explored in our review of Nillion over on the Coin Bureau Club. And you can find the club on our deals page, where you'll also find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashback on deposits of up to 75% on crypto exchanges. These deals won't be around for long, so take advantage of them ASAP using the link down below. Anyways, this is where the real insanity begins. Patamac reportedly took on FTX as a client in January 2022, just 10 months before the infamous crypto exchange imploded. As with the 2008 financial crisis, Atkins reportedly claimed that FTX's collapse was due to a series of factors, not just fraud by SBF. Fast forward to late 2024, when Trump nominated Paul Atkins to be the next SEC chair. Now, there's a crypto headline that seems to have flown under the radar, and that was the news that Atkins was hesitant to become SEC chair. This was reported by CoinDesk, citing unnamed sources, and this is part of what they said. Quote, Atkins is reluctant to leave his practice, the person familiar with his thinking said. Taking up the SEC chair role would require him to resign from his business interests, which he may only do once his firm is well positioned to operate without him, sources said. Translation, Atkins was initially hesitant to leave Patamac to join the SEC, but somewhere along the way, something changed, and he accepted. Now consider this. During Atkins' nomination hearing in March, anti-crypto politician Elizabeth Warren pointed out that he will need to sell Patamac if he's nominated as chair of the SEC, and that Patamac is estimated to be worth $50 million. Warren asked Atkins whether he'd disclose who Patamac would be sold to and for how much, because these buyers could influence his decisions at the SEC. Atkins didn't have a clear answer. All Warren could say was, quote, "Some would call that a pre-bribe." So, in case all of that didn't make it clear enough, it looks like crypto could be virtually unregulated under the SEC's new leadership, if only just because of one simple fact. Paul Atkins is an outspoken libertarian. For those unfamiliar, libertarians believe that government regulations should be minimal and that free markets will practically regulate themselves. Atkins's past suggests he's a true believer, to put it mildly. And if you need more concrete evidence that the SEC is going to be hands-off with crypto, then look no further than all the eye-opening statements that its pro-crypto commissioners have made in recent months. For starters, we have multiple statements that meme coins and NFTs are not securities, which Atkins considers to be as good as gold from a regulatory perspective, according to his recent testimony. Then, in early April, Mark Ueda issued a statement saying, quote, "While the Commission works to develop a long-term solution to address these issues, a time-limited, conditional exemptive relief framework for registrants and non-registrants could allow for greater innovation with blockchain technology within the United States in the near term." Translation: everything in crypto could temporarily be legal in the US. Then, in early May, Hester Peirce added to Ueda's statement from April, saying, quote, "The SEC's crypto task force, informed by a February request for comment, is considering a potential exemptive order that would allow firms to use DLT, that is distributed ledger technology or blockchain to you and me, to issue, trade, and settle securities. This potential conditional exemption from certain SEC registration requirements and associated rules would allow firms to use innovative trading systems for eligible tokenized securities." And, notably, she specified that DeFi would be exempt. As a cherry on top, Peirce said this in late May, quote, "Additionally, the Commission might establish an exemption framework so that certain distributions of crypto assets as part of an airdrop are not deemed offers or sales subject to registration." Now, if you've been keeping up with the channel, you'll know that we've highlighted how wild things could get if airdrops were to be allowed in the US. For instance, we could see crypto wallets announcing airdrops as a means of retaining existing users and attracting new ones. We could see crypto devices like Solana's Seeker phone and Sui's SuiPlay handheld gaming device announce airdrops that offset the cost of the devices themselves. In turn, we could see apps and games on these devices announcing airdrops that make them competitive with similar Web2 companies. And more importantly, this could all be allowed without the need for Congress to approve new crypto regulations, at least according to Atkins. During his most recent hearing, he was asked point blank by pro-crypto politician David Joyce whether the SEC required Congress to craft a new crypto framework. Atkins strongly implied that the SEC already has the authority to make the necessary changes, and even hinted that the roundtables the SEC is conducting with the crypto industry will play a part in these changes. Now, to bring you up to speed, there have been 3 roundtables so far. The first was about securities designations, the second was about custody, and the third was about tokenized real-world assets or RWAs. The SEC's 4th crypto roundtable will be held on the 9th of June, and it will be about, quote, DeFi and the American spirit. When you consider that the SEC started declaring that meme coins aren't securities around the same time that Trump launched his meme coin, it's not far-fetched to assume that we'll see them remove most of the restrictions around DeFi prior to the launch of World Liberty Financial, Trump's DeFi project. And you can learn more about that by using the link in the description, by the way. So, in sum then, it appears that the new look SEC is on track to legalize crypto's Wild West in the US in the name of the free market, in the name of innovation, and in the name of, quote, the American spirit. Now, although this would be unbelievably bullish for crypto in the short term, it could set the stage for a financial catastrophe in the medium to long term. That's just because it looks like history is about to repeat. As a fun fact, stocks didn't become widely accessible to retail investors in the United States until the late 1800s, and it wasn't until the early 1900s that US retail investors started getting more involved in the markets. Any financial historians in the audience will know that the first wave of stock market mania took place during the 1920s. This mania was driven by a combination of factors, and in particular a booming US economy in the wake of World War I. This mania peaked in the late 1920s, and the bubble burst in October 1929. What followed was the Great Depression and the creation of the SEC in 1934, which you'll already know if you've been paying attention. And if you're a financial historian and have been paying extra close attention, you'll know that there are many parallels between the stock market mania of the 1920s and the crypto market of the 2020s. The 1920s were the first time that retail started investing in stocks in size, just like the 2020s are the first time that retail started investing in crypto in size. In the 1920s, pumps and dumps were common due to the lack of disclosures. In the 2020s, pumps and dumps are common in crypto for the same reasons. The most alarming parallel, however, is leverage. During the 1920s, investors borrowed massive amounts of money to buy stocks, sometimes using their existing stock holdings as collateral. In the 2020s, we've seen individuals and institutions borrowing massive amounts of money to buy crypto, sometimes using their existing crypto holdings as collateral. The difference is that we're in the early stages with crypto. If you watched our summary of Galaxy Digital's crypto lending report, you'll know that crypto leverage in CeFi and DeFi still isn't anywhere close to its 2021 highs, crypto treasury strategy stocks notwithstanding. However, this could change if the SEC decides to loosen rules around DeFi, which it looks poised to do. This would make it possible for individuals and institutions in the US to leverage DeFi protocols. As we've also underscored in many of our videos, there are many large cryptos which could be leveraged as collateral in DeFi that are currently limited by their relative lack of programmability, such as BTC, XRP, and others. Programmability, or the lack thereof, isn't really the problem though, because these assets can be wrapped and used on other blockchains. As it so happens, Coinbase is launching exactly these kinds of products. Even so, the real problem is a lack of regulatory clarity around DeFi, and I'll reiterate that the SEC appears to be on the brink of giving this guidance, if not a temporary exemption to all regulations. This could result in tens, possibly hundreds of billions of dollars being borrowed using crypto as collateral. Logically, these billions will likely be reinvested back into crypto, just as retail investors did with their stocks back in the 1920s, and the result could be the exact same thing. A massive melt-up in crypto prices, followed by a meltdown when someone starts selling, and collateral starts being liquidated left and right. The difference, though, is that the crypto debt bubble could theoretically be 40x larger than the stock debt bubble. To put things into perspective, Federal Reserve data shows that investors had borrowed roughly $1.7 billion against their stocks in the early 1920s. At the time of the 1929 crash, this debt had grown to $8.5 billion. If we use DeFi's growth as a parallel, we end up with some pretty staggering statistics. Per that Galaxy Digital report, there was $65 billion of crypto borrowing between CeFi and DeFi in 2021, and the actual number was probably much larger given the opacity of CeFi. But for the sake of simplicity, let's say it was $65 billion. Now, if we assume a 5x increase in crypto borrowing in the coming years, that would translate to total crypto borrows of over $300 billion, likely more due to how easy it is to borrow in DeFi. Lo and behold, it looks like the total value locked in DeFi lending protocols is about to go parabolic. While total value locked is technically different from borrowed value, it doesn't change the fact that the trend is clear. We are about to see a massive breakout in DeFi activity, and that includes borrowing. With the SEC ready to give the all clear, the rally will likely be of historic proportions, but the crash likely will be as well. That's why we reckon it's a good idea to understand exactly how the crypto market works so you don't get caught up in the collapse. And as it so happens, we have a video all about that, which you can find in the top right. So I'll see you there. If you made it this far, thank you for watching, and take care out there, folks, as it could be set to get pretty crazy before too long. This is Guy, over and out.